Here, I'm going to talk about some of the differences having to do with rental expenditures. Generally, the sales tax implications from a rental will mirror those from a purchase. Sales and rentals are treated the same for the most part. Let's look at how remote rental transactions are worked. Since 2018 and the Wayfair decision, remote sellers have had a responsibility to collect on their out-of-state sales. So you have a seller in state A selling to a buyer in state B, and the seller has to collect state B's sales tax. This requirement doesn't kick in until some minimum thresholds are met generally. But if the seller is renting the property, they have a responsibility to collect tax on that first dollar of revenue. The reason being, the economic nexus thresholds, they don't matter when the seller has physical nexus. And if the seller is renting property in a remote state, the ownership of that property gives them the physical connection sufficient to allow that remote state to require collection of tax. Typically, rentals tend to be pretty straightforward. You are asked to be in a wedding, so you rent a tuxedo and pay sales tax on it. But what if a purchaser engages in a transaction without the care, custody, and control of that property transferring from the seller to the buyer? A popular phrase in sales tax circles is equipment with operator. Let's say there's a construction project. Heavy materials need to be transferred around. But it isn't too often that someone actually rents a crane. Most of the time, a crane service is needed. The buyer just wants items moved around. The essence of the transaction is a moving service rather than a rental of property. So the crane company will typically provide an individual who actually operates the crane. This may cause a taxable rental of property to change into a non-taxable service. Software can be very tricky in sales tax. Is it canned or is it custom? Is it software or is it cloud-based software as a service? Another issue that muddles the waters is software being sold or is it being licensed? This issue is similar to the one regarding rentals of property. The major distinction being that different states will treat licenses differently. A recent court case addressed this issue. The taxpayer filed what's known as a voluntary disclosure agreement with a state they thought they had only a remote association with, claiming that they should have paid sales tax for the last year. But when the state reviewed the taxpayer's activities, the Department of Revenue determined that the taxpayer licensed their software. In this state's statute, a license is treated similarly to a rental in that the seller is still the owner and has the rights and privileges to the software license. This caused them to have a physical presence in the state. This distinction between a sale of software versus a license of software caused the taxpayer to owe an additional 3 years of tax. Here's an issue you run into with rentals but not sales. How long is the rental for? An example is motor vehicle rentals in Texas. Motor vehicles rented for less than 31 days in Texas are taxed at 10%. If they're rented for over 30 days and less than 180 days, the rate is 6.25%. And if the rental agreement is for over 180 days, no taxes due at all. This also affects sellers as they are allowed resale exemption in the first two scenarios, but are not eligible for the resale exemption in the last case. Here's another interesting thing about motor vehicle rentals. In some cities, You pay a higher tax rate for vehicles rented from the airport than for vehicles rented from other locations. Now, why do you think that is? A government employee's favorite tax is the one his constituents don't have to pay. So if you live in a particular city, you probably aren't going to fly home and rent a car. Almost all car rentals at airports are paid by those people that don't live there and are visiting and don't vote there. At Clarus, we talk a lot about sales tax, but it's important to recognize that there's a reason our website and business cards don't actually say sales tax. They say indirect tax. And while sales tax is by far the largest component of indirect tax, there are additional taxes falling into this category. Income tax is a direct tax. The person who owes it pays it. Indirect taxes are those that are generally remitted by other than those whose wallets the tax actually comes out of. For instance, look at gas tax. You pay a gas tax when you fill up your vehicle, but it's the seller of the gas that hands it over to the government. One form of indirect tax is hotel occupancy tax, also called transient tax or lodging tax. These hotel taxes tend to be higher than the state's sales tax rate. Also, these taxes are generally designed to be applied only to short-term stays. So there will be exemptions for stays exceeding a minimum threshold. But these thresholds are not typically met, as most of them only kick in after the occupant has stayed in the hotel for 30 days or so. You should also know there are opportunities for refunds we can help you with if you own or manage hotels and use a marketplace facilitator for your bookings. Hotel tax it's a good example of the indirect tax filing requirements Clarus Partners can help you with. It illustrates another of the many nuances in rental transactions.